Good morning, everyone. Thank you for joining us in today's webinar. I hope you can hear me clearly and you can see the presentation as well. So, today we wanted to talk about good investing in bad times. So, today's webinar is basically going to cover things like what is good investing, and are we in good times or are we in bad times, and how can we address what are the investments or what is the approaches that we can use today to navigate whatever market conditions we are facing. So the way we will structure this is typical. Sorry. Yeah, I just wanted to check. Am I audible? Okay. Great. So I think I am audible. So I'll just go ahead. So these were some of the things that we wanted to discuss in today's webinar, and the format is going to be very similar to what we've done so far, which is that we'll do the presentation and we'll keep some time for Q&A. If you have any questions as and when it occurs to you, please type it into the chat or into the Q&A section, and towards the end of the webinar, we'll get through all of this. So thank you everyone for coming in. It is a little early on Saturday morning, but we're looking forward to a very productive and interactive conversation. And with that, I'll begin the presentation. So this is a really interesting quote from Charles Dickens. It's the opening lines of the book called A Tale of Two Cities. And in this, he's talking about how at the same time you can have the best of times and the worst of times. It can be an age of wisdom as well as an age of foolishness, and there is both belief and incredulity that exist, and light and darkness, and hope and despair. So all of this is happening more or less at the same time. And I think if we think about how markets are structured and where we are today, I think you will see there's a lot of this contrast, right? Where you're seeing good things, you're seeing bad things, you're seeing opportunities, you're seeing also some resistance to participate. So the idea is that we can be in times where such paradoxes exist, and I think that is where we are today in the market. So if you think about it, I think at one level we are in the best of times today. And why do we think that? Because if we look at what we've heard in the last year and a half or two on the India story, we've seen that for India, this has been a great starting point for a really bright future, because first you had these big reforms that have resulted in a lot more financial inclusion. This includes your Jam Trinity, which is essentially your Jandan, your Aadhaar, and your mobile. So you've had more people coming in. You've also had UPI. This is all part of your digital stack, right? And then you have other things that are also picking up on the digital side. Then we have what is basically India's demographic dividend, which is essentially that you have a lot of young people coming into the workforce. You have a lot of young people, or unlike the other advanced as well as emerging economies, India seems to have not a population degrowth problem, right? So in that sense, also things are looking much brighter. And then we've had reforms like Make in India as well as the PLI, which have basically brought manufacturing as a theme back to front and center in terms of attention. And those are themes that can play out for decades together. It's not something that happens just over a period of a few years. And of course, you're seeing a lot of data on infrastructure as well. So when you look at all of these elements coming together, it looks like India is in a very, very promising space. And at the same time, last year was a year where most economies were degrowing. India was the only one that was in higher single-digit growth numbers. And we've had even the RBI governor come forward and say that this is the fourth consecutive year where you can see 7% plus growth, right? So when we look at where India is, we're definitely sitting in the sweet spot. So these are projections that have come from the RBI itself in terms of how your inflation and growth numbers are going to be. As we know, inflation has been a big priority in terms of talking points, in terms of policy decisions. It has been a problem not just in India but across the world. Most central banks have been worried about how inflation is playing out and how long it might take before it normalizes. So if we look at what's happening or what is expected to happen in inflation in India this year, the projections for RBI for FY 24-25 is that we'll have a net rate of maybe 4.5%, which is quite close to our target range of 4% and definitely within the band of 2 to 6%, right? On the growth side, the projections are closer to 7% for the financial year, but commentary still gives room for upside. So it could be higher than 7% where we are today. So clearly we are in a good wicket, right? And this is not just about what we think about India, it's also about how flows have come in. So if you look at FIIs, we've had some sellouts that have happened this year, and then in June, July, they've been coming back, right? Similarly, for DIIs, your monthly flows has been strong. And this is the first time in our history, at least, where we are seeing DII flows able to match and outpace FII outflows, which is why, despite all of the money that has gone out of markets, you've still seen some level of stability, right? The market has not really crashed because of strong FII outflows. So we're really in that can't stop, won't stop moment because there is a lot of money that is coming into our markets. And if we look at how the participation has also been, it's not been just one or two things that have done well. If we look at how the Nifty performed, in June, you have about 43 out of your 50 companies that are in positive territory. And then almost 49 out of 50 companies are basically under 5%. I mean, your maximum drawdown is 5% or less, right? So clearly this is broad-based within the key index, but it's also given how small and mid cap as segments have been performing. It's not just restricted to one set of stocks. You're seeing a very broad rally in equity markets. And if you look at how India's perception in the world also, I think you will notice that our contribution to the global market cap is actually at an all-time high. So our historical average has been under 3%, and right now we are at about 4%, right? And if we look at 1 month performance, that is June's performance, India has been one of the better markets across the globe. So clearly, we are pulling our weight, and there is a lot of opportunity here, and it's not just a handful of believers. It's a very broad and diverse set of believers in what is happening in the Indian market. And this trend is not limited only to equities. You're seeing it in fixed income as well. There's a really nice article called India's Bond with the World, and I would recommend everyone to read it. It will take 5 minutes of your time. But essentially, it talks about how the JP Morgan index inclusion has been a game changer because we're expecting about $20 to $25 billion in terms of flows coming into the markets. We've already seen a good amount. The announcement was made in June last year, but you've already seen significant FII participation. And this gradual weight increase of India in the JP Morgan index will go from 1% to 10% between now and March next year, right? Bloomberg has also made an announcement to include India in their index. And then you have another index called FTSE, which is a UK-based index, where they've not confirmed, but essentially there is enough interest in Indian sovereign debt that you're having multiple indices across the world sort of want to participate. And this means that obviously the largest weight is JP Morgan in terms of flows that will come into India. But clearly there are other players, right? And the appetite has changed. Earlier this year, we saw our outlook, S&P sort of raise the outlook to positive. And if we keep in line with certain parameters, we could very well see a ratings upgrade in a few years' time, right? So from a bond market perspective also, there are a lot of positives to review. And if we look at gold as an asset class, this is from a report called In Gold We Trust. And essentially, if you look at where the expectation is in terms of price distribution, it's very likely that you're going to see an increase in gold, right? And there are a lot of drivers for precious metals in general. One is, of course, in terms of mining and availability. The second is the changing currency order that you're seeing in the world. And the third is, of course, that you've had a period of high inflation. You've had central banks also move towards this new system. So structurally, there are things that are changing for precious metals. But of course, that journey, as with any commodity, is not going to be a straightforward one. It is going to be something where you will have more volatility in that path. So these are all of the positive things. But are we also in the worst of times? Right? That is a question that we have to ask ourselves today. And if we look at what is happening, we're really walking in very shallow waters. So for somebody who wants to be a value investor and who wants to be careful about where they're participating, the pool of opportunities is actually shrinking quite quickly, right? So this is an interesting chart that we wanted to share with everyone, where this broadly, if you look at the spheres or the circles that are there on this chart, they basically tell you how much that particular sector is contributing to the profit pool of NSE 200. And your green, orange, and red boxes are essentially showing you how much, like where the valuation is, right? So obviously the green area is clear value, your orange area is mid to high valuation, and your red box is very high valuation, right? So if we look at this, what you're seeing is that largely the biggest contributors are private banks contributing about 26%. You have industrials at 15%, which have actually run up. Then you have auto, healthcare, IT, as well as PSU banks that contribute. Now, both PSU banks and private banks have seen a pretty good rally in the last few months. You're seeing IT also, in the last month, you're seeing IT also rally in the last couple of weeks and like through this year. So the opportunities are actually moving very quickly. Everything is getting more expensive. So there is a need to be a little bit cautious about what you're getting in, right? Because essentially when things move up or people are willing to pay more for companies, that means the expectations from the companies are also increasing, right? And when your expectations increase, small disappointments can turn out to be large price corrections. So that's something we need to be a little cautious of, right? So the other trend is that investors have been climbing down the quality ladder. And this is also another interesting chart where it shows you what your margin of safety is, right? So typically there needs to be a risk spread. That is what you call your comfort level, right? You would pay more for a better quality or a larger company simply because of its ability to survive. So that spread in terms of micro, small, and mid caps, where we are today, is actually close to zero. So there is actually no margin of safety that investors have. and they've been moving down the quality ladder to maintain a certain risk return profile. So if we look at safety in size, you're seeing that the opportunities in large caps have more or less been a little bit more stable over the last, like if we compare to say maybe 8, 10 years ago, we're not doing too badly. Your large cap valuations are still a little bit better than your mid, small, and micro, but it's still not cheap. So if we look at Nifty itself, your Nifty 50, your 10-year average in terms of price to book is under 3, right? And today we're at 3.3. So it's definitely not cheap, right? And if we look at the individual constituents, right? So half of them have been trading at a premium to past valuations. And if we look at sectors, then two-thirds of sectors are actually trading at a premium to past valuations. So clearly, like, yes, there is an opportunity. Yes, there is interest in our markets. But also today is we need to be very careful that valuations are not that favorable, right? So the sentiment is there, but when we really look down at the numbers, that is not there. And if we move on to fixed income, we'll see that in terms of the yield curve, we are still at a very, very flat yield curve, right? Because your 1 year rates are close to 6.8%, and your 20-year rates are close to 7.1%. So there's barely a 0.2% difference between this. And of course, because the flows have predominantly come into the 10-year, but you do have other securities that are qualified as FAR, right, or fully accessible. You are seeing interest in the longer term segment from foreign investors. So with a flat yield curve, there isn't too much that an investor can do in terms of seeking mark-to-market gains. You need to be very careful. There might be very selective entry points where somebody can move into longer-term debt. But if we look at that, I think on the shorter end, things are pretty attractively valued. You are seeing more NBFCs come into the market to borrow, and you're getting good yields on those bonds. So whether you want to participate through a mutual fund or participate through selective bond issuances, there are opportunities for a fixed income investor today. So let's also try to follow the money and see where that has been going, right? So if we look at where we are today in terms of risk and uncertainty, then I think you're seeing that money has really flowed out of equity into fixed income, right? And what does that tell us? It essentially tells us that if we look at the flows, so you have liquid in light gray, you have debt in dark gray, and you have your passive in light red and your equity in dark red, right? So your passive part of the pie has actually shot up quite a bit in, say, from 2020 to 2024. Your equity flows have basically had the lion's share, right? And the last time we saw this was basically in 2018. And that happened essentially because 2017 was like that led up to the bull run. And then you had people come in 2018 and participate more. And then you had 1 or 2 years of muted returns. Then you had COVID. And then, of course, that changed the whole story, right? But essentially, the other big change is that once your indexation was removed on debt, the participation in debt and liquid schemes has basically been negative in 2023. And you've had some money come into debt in 2024, but basically no money in liquid. Even though you've had a flat yield curve and even though people could have earned, say, 7% risk-free, that participation has been really less. There are expectations, I guess, that going forward, there will be participation in debt. But if we really look at the kind of conversations investors want to have today, then a lot of it is very performance oriented. There isn't enough conversation happening on managing risk, maintaining liquidity, preparing for the next set of opportunities. A lot of it is about making returns now. So whether that trend will change or what will trigger the trend to move back towards safety, we are yet to understand what that trigger will be. So if we also look at SIPs, this data is actually a little bit concerning in terms of the fact that, of course, new SIPs are getting registered, but existing SIPs are also getting discontinued. And the power of an SIP or a systematic investment plan is really in the fact that people stay invested for long periods of time. So moving out from one SIP to another or switching out is really not helping investors, and that is what keeps us a little bit concerned, because if you look at the red line, which is your net additions have actually come down in 2024. And people have been discontinuing SIPs at a very fast rate. So why we think that this could be the worst of times is because people are quite, you know, conscious of how much return they're doing, right? Mm-hmm. So if we look at traditional fixed income investors who used to buy deposits and bonds, their conversations are more along the lines of whether they're performing poorly, whether they can actually use fixed income to create wealth in the long run. Why should they have investments in safer avenues when, say, some portion of their equity portfolio has done really well? And specifically with the tax change, there's been a lot of disincentive to be in fixed income, because everybody realizes that at the slab rate, the post-tax returns are really not that attractive, right? So this is why I think we look at this in terms of the worst of times, because while there is opportunity, there is also a lot of concern in participating in these opportunities. And this is not coming just from us. This is coming even from the SEBI chairperson, Madhavi Puri-Buch, where she has been very vocal in the last few months about how F&O activity is really affecting investors as well as household stability and household savings and financial stability, right? Because more and more people are getting into this speculative activity through F&O. It's been facilitated through the access of technology, internet, as well as platforms that have enabled this. And essentially what is happening is you're not actually contributing to the economy, you're not actually participating in capital formation. It's purely speculation, right? And that is history has shown us that essentially that never really ends well for everybody. There's always someone who takes a big hit on that. And given the amount of retail participation, you're really going to see those people get affected the most. Which brings us to the most important question. What is good investing, right? So we've seen the best of times, we've seen the worst of times, and we're actually living in this point where both exist together. So one thing is, whatever is true of men is also true of our markets, right? So you have hard times create strong men create good times, and good times create weak men, and then weak men create hard times, right? So this is an important quote that gets said in all succession planning discussions, but it's also true of the market. So if we have a really strong market today, then you have good times, and then if you have good times, then people become a little bit more careless with their investing, and when they become more careless with their investing, then you're heading into tough times, and that will bring us back to the beginning of the cycle. So let's try to understand what is good investing, right? Good investing, of course, to a lot of investors is good returns, but it's also more consistent returns. That is, you don't want to have lumpy returns all the time. It's also smaller drawdowns, right? Which is that you're making good returns, but your drawdowns are also not too bad when things go south. And it is most importantly stress-free investing, because you want to make sure that you're not worried, you enjoy this journey that you're on. And good investing is always process oriented. And for every investor, it needs to be goal oriented. So unless we're clear about what we want, we can't really be good investors. So I'd like to look at three things here, which is contrarian investing, multi-asset value investing, and multi-asset investing, and how these things make us better investors. So this is from John Neff. He used to work in Vanguard, and he was a fund manager for one of their Wellington funds. And I really like this quote because it symbolizes what contrarian investing is, which is that it's not always easy. And to be a contrarian investor, you have to look at stocks that look bad to people who are less careful than you, and you have to hang on to them until other people recognize their real value, right? And of course, the common thing is to basically buy when others don't want to buy, which is on the cannons, and sell when other people are ready to enter. I also like this quote, which is essentially tells us that when the world wants to buy only bonds, you can almost close your eyes and buy stocks. I think today we're in the opposite scenario, right? Which is that everybody wants to buy equities, and there couldn't be a bigger contrarian signal to take some money off the table and be a little bit more cautious in what we're doing. But the most important thing, and I guess this is what we all need to be mindful of, is that if you do it too small, it's not meaningful. So if you just put in 1% of your portfolio in something more safe today, it's not going to have a meaningful impact when the tide turns. And at the same time, if you do it too big, you can be completely wiped out, which is that if this rally goes on much longer, you can't really, you're going to miss out on a lot. And you can get completely wiped out, right? So the idea is to find that very nuanced balance between how much you want to take into lower risk, how much you want to be contrarian about, and how much you want to really put on the table and stick your neck out for. So I also would like to look at what value investing is. And when we look at this, we have a really great quote from Charlie Munger where he says that value investing will essentially never go out of style because it will always be relevant. And why is it always relevant? Because the philosophy is so simple, right? If I buy something for less than what it's worth, then eventually the market will at least recognize its true worth or give it more value. And when that happens, you're definitely going to make a profit, right? So that's the basic reason why value investing can never go out of style. And we also have this really nice quote from Seth Klarman, where he says that, it is the only reliable North Star for those who are able to remain patient, long-term oriented, and risk averse. So those of us who think that we're not very aggressive and that we're not really risk takers when it comes to investing, I think value and contrarian investing are actually better suited for us, right? So it's more suited to a more conservative risk profile. And so lastly, this tells us that value plus contrarian investing gives us good returns, gives us more consistent returns, and that's only a part of the solution, right? So let's look at the next part of the solution, which is closer to multi-asset investing, where here we have a quote from Peter Bernstein, where he says that I view diversification not only as a survival strategy, but as an aggressive strategy, right? Because those people who think that if I'm diversifying, I'm actually diluting or I'm reducing the risk, you're not actually doing that, because essentially when you have a multi-asset portfolio, you really don't know where the next winner is going to come from. And because that can be a surprising place, diversification is one, protects you, but it also allows you to participate in the upside. So if we look at multi-asset investing, you ensure that you have assets in your portfolio that have low correlation, which means that in a wider range of scenarios, we're actually going to do better, which again translates into more consistent returns, right? And smaller drawdowns. So if you have more consistent returns and you have smaller drawdowns, you're definitely going to be a lot more stress free. So if you can have some process, right, in how you're doing this multi-asset construction, then you can also uh, be a little bit more process oriented. And this is what low correlation looks like. So this is data from Bandhan AMC. And if you look at how low correlation works, if you look at Nifty, which is your equity large cap index, its correlation with the global. So MSCI ACWI is basically your global uh, equity index. That's a pretty low correlation of 0.26. With gold, you have a negative correlation, and with debt, you have a very small positive correlation. And if we run this across for each of the assets, you see that when you combine all of these elements together, you actually have a much better diversified portfolio. Right? And this is why it works, because in scenarios where your macros change, in scenarios where your opportunities change, there will be at least one part of the portfolio that's working for you. So Sphere is basically where the magic happens, primarily because we are a multi-asset portfolio. We do we have a philosophy where we follow both value and contra investing, and so we're able to bring in all of these elements of what good investing is into the portfolio, right? So just to show you in terms of drawdowns, so our biggest drawdown has been about 11%. At that time, the Nifty fell 16% and the multi-asset index fell 8%. So we're somewhere between a multi-asset index, which has almost 40% in cash like instruments through arbitrage, and a pure equity index. So on election day, which was essentially June, you had seen a large drawdown in the market. So the Nifty was down 6%, we were down around 4%, and the multi-asset index was down about 3%. So these are things, this is in terms of downside protection. And if we look at performance, we benchmark Sphere, which is in red, against against your Nifty multi-asset, which is the benchmark, against the Nifty 50, which is a pure equity large cap index, against a dynamic asset funds as a category, against multi-asset funds as a category, as well as against flexi cap, right? Because essentially flexi cap, since Sphere is more has a higher allocation to equity today as a portfolio, we felt that it would be fair to benchmark against a pure equity flexi cap category as well. So if you can see, we have been pretty good on the performance front. This is data as of June 30th. And if I can show you our performance against benchmarks, etc., you can see that our since inception returns have been close to 24% compounded. We started Sphere in December 2021. So we'll be turning 3 later this year. But our 2-year, 1-year performance has also been pretty good. Most important thing in terms of performance is that, see, we understand that this is still a young product. We would like to work for some more time before we can really talk about this. And Sphere is a PMS registered with SEBI. So our minimum investment by SEBI guidelines is 50 lakhs. Our benchmark is the NSE Multi-Asset Index 1, which is 50% equities, 40% arbitrage, and 10% rates, as well as InvITs. There is no exit load. We have a flat fee, so no profit sharing with the investor. And we have a very flexible asset allocation where we can go from 0 to 100 in any of the investments that we want. Right? So this is our entire team. A lot of people working on the ithoughtpms products across Solitaire, True, Vriddhi, and Sphere. And with that, I'll open to questions. I see a couple already in the chat, so let me take that. Okay, so the first question is for today's news reported inflation is high at 5.1%, but most common staples are more than 20%. Yes, so I think, see, the way that inflation gets calculated in terms of an academic or like, your official statistics is that they have a basket, and it's not necessary that the basket is what we would face as day-to-day inflation, right? And then it's based off a different index here. So the prints that you see are basically just indicators. I don't think they're a reflection of how much your household bill is actually going up, right? Uh, and yes, it is inflation is high, and that is one of the reasons why. But ideally, like what you want to look at is how this is going to play out, right? So, what is it that the government and the RBI have been doing so far to contain inflation? One is in terms of money supply, they've kept it a little bit tighter. Your liquidity conditions are a little bit more tight. The second is that there have been a lot of supply side interventions. So, yes, we are facing higher inflation, but you also have to look at it in tandem with what is happening in terms of policy. So if you open the newspaper, you can see that, excuse me, even this week there was an article on exporting, on bans on exporting rice. So, uh, and you'll see that we're importing a lot more food. Yes, it is higher, it is a problem. That's also why we feel that, a rate cut is not something that may come in quickly, and that a flat yield curve may not really make sense because there has to be some response to what is going on. So I think end we are kind of saying, making the same point. Your inflation, but we have made significant progress in terms of from where we were to where we are going or where we are today. The second thing also being that the RBI is very, very cautious of where inflation is, right? So if you go through any of their commentary, any of their post-policy conferences, they have specifically said that, inflation is something that we're worried about. We have to look at how the monsoon plays out. We are not making any decisions until we are clear on that point. Just give me 1 second. Okay, so see, I think as far as where the yields will go, it makes sense to wait for the budget, right? This is a very interesting point that you make, which is that because of the RBI's higher dividend, is it likely that the government will borrow less from the market? And because there will be less supply, the yields will also go down. So is it good to sort of participate now? Broadly, if that's your view, then you want to participate immediately so that you benefit from that mark to market movement, right? But it could also mean that the government borrows more. It could also, as in that they still borrow what they plan to borrow, and they just have a wider deficit. The second is because we really have to wait for the budget, right? Because the budget will provide a lot of clarity on this thing of fiscal consolidation, where the money is going to come from, and how that's going to pan out. There have been concerns post-election, of course, that there could be more populist measures, there could be certain other things. So far, we've not seen anything, but again, the budget will put out a lot of clarity on how that's going to play out. And like we had that comment on inflation. If you do see a few prints of inflation that are out of your expectation zone, it's very likely that your yield curve will move and you might get a opportunity to enter. So that being said, I think where we are right now is a good time to participate. It's also you need to be open to the fact that you might get a better opportunity later, which means that both you need to do it in layers, right? These kind of investments are not just once and done. You do need to respond to the opportunity as and when it evolves and it changes. So I think this question we've answered in every webinar. So when we show you the graph of 75% or 76% in equities, this is on the overall scheme level. So the way that we construct portfolios is that we do it at a point in time. Obviously, a lot of our investors have been with us from the earlier parts of our journey, which means for them, when we started investing, equity had a higher opportunity. We don't do this churning in and churning out. We like to keep investments long term and tax efficient for investors, which essentially means that somebody who's come in earlier, a bulk of our assets have actually been coming in slowly over a period of time, right? So newer portfolios are likely to have a much higher allocation to other assets than the older portfolios. But the older portfolios obviously contribute to a larger share of the pie. And so that is why your overall asset allocation looks like this. But for somebody who wants to participate today, your asset allocation will look different. So this is how we're able to customize and respond to opportunities. And this is what we are committed to doing. Some AMCs like ICICI Pru are providing direct PMS for 1%. No comments. Okay. I mean, see, it's up to you. If you're comfortable with what somebody is doing and you like that process, I think you can definitely choose that product. There's no problem. Yeah, so huge inflows coming in from the JP Morgan in the bond market. So what will be the future? So I think that that's a very interesting question. We do see a lot more FII participation in the bond market. So when we were looking at the months where there were outflows from equity, there were actually large inflows into fixed income. So clearly, I think the appetite for Indian bonds is going up, and the future does look bright if you ask me. Banking liquidity continues to be in deficit. See, I think this is basically this month is pre-budget, right? So you've not really had any government spending or large government spending happen after the elections, and because of that, you essentially will have slightly tighter liquidity conditions and your bond yields will be elevated, which is also a good reason to participate now. This is like a seasonal liquidity thing that will happen. So it's not a permanent situation. And even in terms of how the RBI is managing liquidity, they've been very proactive. So they've said that, as if there's ever too much tightness in the system, they'll come and they'll intervene. The intervention has more or less been proactive. So it's not like they waited for an issue before infusing liquidity, but I don't think it's a big concern. What is Sphere's investment strategy? Do they invest periodically or keep cash and invest during market corrections? Yes. So we in all of our portfolio management services, cash call is a very important thing. It's not that even on day one, if an investor gives us money, it's not that everything gets deployed. It takes a while for it to get deployed into markets. And we do take cash calls so that we can participate during market corrections. We also encourage investors to use these portfolio management services as savings vehicles, right? It's not just a PMS scheme. We want you to be able to use this to save towards your goals and to, be able to participate in it at different points in the market. So that's our broad philosophy. I hope that answers your questions. Does Sphere invest outside India or only Indian equity, debt, and gold? We have some global exposure as well. This is primarily through the mutual fund and ETF route. Okay. So there was a question from Mr. Praveen Kumar about who will spoil this bull market. Just because it's high valuation, it doesn't mean the market will fall, right? I wish I knew the answer to this question. It would give me a lot of clarity and peace on how to proceed going forward. But you're right in the sense that just because we think that it's overvalued today doesn't mean that the market has to correct. Because essentially markets can be irrational for a long time and you never really know what the trigger is, right? It can be something small, it can be something big. Um, because I feel this year there's not really been any bad reaction to the market, even when there's been bad news. So it's tough to say what will change the direction. Okay. Okay, so if you can comment on FCNR term deposit versus NREFTs, which one is more logical? Currently, for FCNR deposits at 5.8% versus 7.5% for NREFTs. See, I think one is essentially that boils down to a currency question, right? And it's very, very difficult to get your currency prediction right because people have been talking about how the dollar has been overvalued for a while, but we've not really seen any correction happen on that front. Um, at the same time, we've never been able to predict years where the dollar has been very strong. So the more practical way to look at this, I think, from your perspective, would be in terms of where is this money going to get used, right? If this money is going to get used in India, then definitely the NREFT makes sense. That is whether you're going to eventually move that into another asset in India, or if you just want that money for you to spend, or if it's part of your retirement corpus, because essentially you're not paying tax on your NREFT. Now, as far as the FCNR is concerned, if you're going to use that in where you're staying or if you're going to be traveling, then I think it makes sense to have it in the FCNR. That is the way that I would answer that question. Going forward, also, if we look at from an interest rate perspective, I guess your dollar interest rate will, from whatever commentary we've had from from the Fed chairman this week, I think the US is looking at lower interest rates going forward, right? Um, so I guess that is where it would stand. Whereas I don't think Indian rates are going to get cut anytime soon. Okay. Equity markets are overheated. So what is the money deployment strategy? I think always be careful, right? Participate, like for us, you may not be seeing too much opportunity in equity. If you're not, then you're getting opportunities to participate in other asset classes. So why? If you're not sure which other asset classes, just stay in liquid for a while. It'll test your patience for sure, but it's better to be safe than sorry, right? Please share past performance of Sphere. I can just take you back to this slide. I guess this will show you our 1 year, 1 month, 3 month, 6 month, 1 year, 2 year performance. I don't think we can share specific portfolio details on public platforms. So unfortunately, I'll not be able to answer this question on what ETFs we hold. What can one expect from SEBI's action on curbing derivatives markets in the near and long term? I think one is slowing down the level of participation or the depth of participation there. But at the same time, you're still, I mean, it doesn't mean that there won't be workarounds. It doesn't mean that people will fully stop participating. But hopefully, the intent is to take things in the right direction, right? So the intent is essentially that you want people to follow a more safer approach to investing, a more stable approach to investing, and a more productive approach to investing. So maybe that is something that will happen. Okay. If equity market is overheated, then what is the recommendation on other ithought products like MFDs? Is it safer to repurpose the current corpus to debt funds and reduce the SIPs to equity? Eventually, how this theory is spanning to other products of ithought? This is a great question. I think if you look at how the MFD accounts are actually managed, we have been talking to investors about not doing lump sums in every equity scheme. Those happen very gradually. There are selective parts where we find when we find the valuations attractive, where we ensure that investors are able to participate through lump sums. You can continue SIPs at this point, because essentially what I said is that when we suggest an SIP to an investor, it's very likely that we're doing it with a 5-year horizon in mind. So I don't think you should discontinue your SIPs, whether it's in equity or not. If you have incremental monies and you want to put in fixed income, you can do that. If you are yourself a little bit uncomfortable with the level of equity SIPs, you can look at fixed income. So this is something that we're working with all clients on the MFD side as well, where we are handholding them and letting them know where the opportunity is. Okay, so there was one more question on what is the future of banks. The CASA and FD keep on decreasing. Yeah, this is actually a thing that the regulators have been trying to address, which is essentially how uh, can they bring the credit deposit ratio up, right? And one side is of course to increase deposit rates. If you're reading the papers, there's a lot of speculation on whether there'll be like a tax break for FDs, etc. So we really don't know from a reform perspective or from that side what they will do. But it is a problem, and it's not something that isn't in the limelight, right? You had the SEBI chairman talk about it, or the SEBI chairperson rather. You've had the RBI governor talk about it. So I think it is on everybody's mind. Like, how can we solve this problem? How do we make sure that your deposit ratio goes up? Uh, but also, like, one thing is the reason why you're seeing this trend. Like, if you're looking at data from say 2 years ago, 3 years ago with today, part of it is also because of the merger between HDFC Bank and HDFC, right? Because you didn't have these requirements for the NBFC sector, but you do have it for the banking sector. And that merger, like the original timelines that they expected in terms of normalizing these ratios, have been uh, like delayed. So that overhang is there in the system. I don't have any expectations from the budget because it will be interesting to see what comes in. One thing, I mean, personally, I think that in terms of fiscal consolidation, they've been quite disciplined. So it's very likely that that trajectory will continue. But I'm not sure really in terms of what is going to happen. Uh, it's just, I mean, even from my side, I will just be very open. It is kind of speculation, right? I don't know anything to make this comment. Uh, but what we are doing is we'll be hosting a Twitter Spaces after the budget to sort of decode everything that happened, and we'll be very happy to share our thoughts and views and understanding of these things in that session. So I think our social media team will also be putting up uh, the invites for that closer to the date, and we hope to see you there. Thank you, sir. I've tried my best, and we enjoy actually doing this every week with investors to see what is on their mind, to try to answer their questions, and to be prepared. We also learn a lot from this. Contingency plans in what sense? I mean, I think like broadly the philosophy is that we can't predict anything, but we're always prepared for the market to behave in unexpected ways. That is how we operate. Okay, so thank you everyone for joining us. I think it's been a very productive conversation this morning. Thank you all for, yes, yeah, please. Let me answer the YouTube questions as well. Thank you, sir. Very kind of you to say that. If you have any specific sessions that you want us to talk about, you can please write to us. I think this is I've shared our number here, and definitely one of our colleagues or even I will be happy to take it up and organize a webinar on topics that are keeping you interested. As a Sphere customer, if we were to have additional funds and want to be conservative, would you recommend MF for top up of Sphere funds? Um, I think both would work. I mean, as far as you ask any of us, right, in the organization, we don't treat it whether it's a client who has Sphere plus another PMS product or Sphere plus MF. Then we don't really do this A versus B. We try to make things complement each other as much as possible, which essentially means that we will be conservative. I guess on the MFD side, if you have a specific request, it's easier or it's possible to accommodate what you want and customize it fully on the MFD side. On the portfolio management side, there is less discretion for the investor because this is a discretionary PMS, so you may not have control over where it goes directly. But the idea is that both will follow the same philosophy, right? In terms of how we manage risk and uh, how we want to help the investor navigate different market conditions. Okay, what can we be prepared now for the next 1 year? I think I'm very glad this question came, and I think we should spend some time understanding what we can do in the next 1 year. The first and most important thing for every investor would be to review their portfolios, right? You had really stellar performance across all asset classes today. And because of that, it's a great time to review and rebalance your portfolio. So this is an opportunity for you to take out some profits, make your portfolio stronger in terms of quality, stick to stocks that have better valuations, and create some liquidity so that you can re-enter the markets when you get an opportunity, right? So that's the number one thing. The number two thing is to start moving funds into different assets so that you have a more balanced or diverse asset allocation today. Again, because the opportunities are available in every asset class, it's not just one or two that are going to be performers, right? This is the second important thing. The third thing is to actually sit and plan because I feel this is a time in the market where there's a lot of activity happening in the market. And if we're being too close to that, we might lose sight of the bigger picture. So if you've not got a financial plan or if you've not written a financial plan, this is a great time for you to actually do that because when the market is being very hyperactive, if we can be a little bit more thoughtful, I think the outcomes for wealth creation can be much, much better for you. So this is what I would say that in the next 1 year, this should be your plan. You can also, if you're a DIY investor and you do your own research, then I would suggest use this time to look at companies that you like, not necessarily those that have great valuations, but just companies that you like because you don't know in the next 1 year, maybe you might get it at a valuation also that you like, right? I hope that answers your question. Any plan to add SME investing in portfolio? No, not at the moment. We prefer to be safer. We need to have lower risk. We like companies with good governance and track record. And we're finding a lot of opportunities in safer spaces of the market. So I think we will continue to focus there than anywhere else. Any more questions from YouTube, Gopi, Aishu? Okay. Then I would just like to thank everyone for sitting with us. and spending this time and participating with so much enthusiasm, asking questions. They've been very interesting and challenging questions. We hope to see you soon at one of our other webinars. We have two more webinars happening today. One of them is in Tamil. So uh, just very thankful for everyone who's been here today asking questions and participating. Thank you.